Good afternoon, everybody. Uneducated Economist here. I've been reading a lot about the Federal Reserve and trying to figure out how it is that they are going to raise the inflation expectations here in the United States. Because up until just recently, up until like last week, the Federal Reserve has tried to maintain a 2% inflation target, where they would get inflation to 2% and try and maintain that 2%, indefinitely. But they failed at it. They have not been able to achieve that 2% inflation target for like the last 10 years. They have only hit it a couple of times. So they changed their policy, their stance on inflation, and what they're going to do is allow inflation to run hotter than normal and run for a 2% average inflation target over time, so that the long-term average inflation is 2%. So if you're running low like we have for the last 10 years, then the next few years are going to have to run hot. And then when you get the average inflation up to 2%, that's when the interest rates will start to rise and stuff like that. Okay, so this is the idea of the Federal Reserve in order to achieve an inflation expectation of 2%. Here's the problem. They don't state how it is that they intend to get inflation expectations to rise. See, now typically the Federal Reserve during like a downturn would drop interest rates around 5%. This 5% drop in interest rates would start sparking people to go out there and take out loans to buy houses and cars and go on vacation, get them to spend their money into the economy. Well, right now they're sitting at 0% interest and they have no room to drop interest rates down, especially drop them down that 5% that they would typically want to do. So they know that there is no room in monetary policy in order to stimulate the economy. So they're not asking, they're pretty much stating that the government has to do some sort of fiscal stimulus in order to spawn that economic growth into the economy, because the monetary policy isn't going to do it. They don't have any room to move the interest rates down. Now, part of this whole game is to keep the yield curve steep. Okay, now this is kind of hard to wrap your mind around if you're not familiar with treasuries and bonds and stuff like that. But a bond is a loan to the government, okay? Just like any loan, when you take out a short-term loan, you pay a lesser interest rate than if you take out a long-term loan. 15-year mortgage has lesser interest rate than a 30-year mortgage. Bonds are the same way. 1-month bonds pay, a lower yield than 30-year bonds, okay? And this is pretty typical, but what you end up having sometimes is a yield curve inversion where the short-term interest rates rise above the long-term interest rates. And this is an indicator of, generally it's an indicator of a recession, but it's an indicator of investors and their perception of interest or of inflation, okay? Because you think about it, inflation is what? It's the increase in money supply, but the way the Federal Reserve and everybody else judges it, it's an increase in pricing. Okay, so when prices inflate or go up, your purchasing power on your money goes down. So if you're an investor standing there with money in your hand and you have the opportunity to buy bonds or loan the money to the government, and you are going to loan it out for 30 years, you're going to expect a higher interest rate. But if your expectation of the future has a deflationary scenario to it, where you're expecting that prices are going to drop into the future, then you are going to demand more money right now, or demand a higher interest rate for your money right now than you would in the future, because your buying power in the future is going to increase during a deflationary scenario, right? So if it's a short-term bond that you're going to loan, you're going to demand higher interest rates. This is where the yield curve inverts. Okay, it's inflation expectation. If you have this expectation of deflation into the future, then you're going to want more money. You're going to want a higher interest rate for your money today. But if you feel that inflation is going to be much higher into the future, then you're going to demand a higher interest rate for your money into the future. Okay, so if you can get that yield curve to steepen, then you're going to bring in this perception, this expectation of inflation being higher into the future. So what the Federal Reserve, for the quantitative easing programs, now it's best to look back at 2010-11 when they did the very first quantitative easings, okay? And the whole idea behind it is that they were going to bring down that short-term interest rates on those treasuries, causing the long terms to be higher, creating that steepening of the yield curve, raising inflation expectations. But all this money creation did not have that same effect on the investors, because they saw that money creation and they went and they ran into gold. And that's when you saw gold run up to $1,900 an ounce. Okay, so the inflation expectation did not go to where the Federal Reserve was hoping it was going to land. They weren't clear enough on what they were doing, I guess is the only say, what they were trying to target. And so they had to come up with more quantitative easing programs. Okay, and when they raised up the quantitative easing programs and started pushing it out into QE2 and QE3, by 2012, they started raising that inflation expectations within the investors, and they saw that real estate and equities were going to be the place to be. And they started pouring into those areas. So like the Federal Reserve kind of screwed up in the first quantitative easing programs, where they didn't quite clear enough on what it was that they were planning here, because they have absolutely no problems. And I got to thinking about this, especially after I read this article that I'm going to leave down in the description for you guys, because that's basically what this article is talking about, is everything I'm saying here. But the Federal Reserve, they really anticipate higher asset prices. Like, they want higher assets, like real estate and stocks and all that. They want those things to be elevated in price, because when they do, then it gives the people the wealth effect. Like, even if they don't cash out, okay, and you're sitting on your stock portfolio, right? And you got this stock portfolio, and say you got a lot of money in there. Say you got like $800,000 in there, right? Maybe to a lot of people that's not a lot of money. To me, that's like an ungodly amount of money. But say you have like $800,000 in your stock portfolio, and then a year later you have like well over $1 million in there, right? Like the stock market just shot up, okay, and you got like all this extra money, all this growth in your portfolio that you were not expecting. And you feel good about that money being in there, and you're thinking, well, I got all this money in there. Yeah, I guess I could go buy that new truck. I mean, shoot, look at all this money I got in my portfolio. And so you go out there and you buy yourself a new truck. But you never like take that money out of the portfolio. You just have this feeling that you have this money, and so you're okay with spending the money you do have. You see how that works? So like, if this portfolio goes up in price, or same thing with your house. You're sitting in there in your house, and you're like, man, I bought this house for $150,000. Now it's worth $325,000. Yeah, let's go on vacation. I mean, we can afford it. We got all this value in our house now that we could pull out if we wanted to. We could pull the equity out. So it raises this wealth effect. Like, if you have something that increases in value, even if you don't sell it, you just feel like you have more money because you own that particular item. And that's what the Federal Reserve is really shooting for, is to get this wealth effect running for the people, so that they feel more comfortable about going out there and spending their money. They're figuring out all kinds of ways to get you to spend your money. I mean, I think about like the stimulus checks. I mean, I don't know, like I said it in previous videos, but I don't know how many like headlines, and I still see them today, like, when to expect and how much would you expect out of the next stimulus check? And it's just like, there is no promise of any stimulus check right now. But yet I see people talking about it all the time. And a lot of people are expecting the stimulus check. In fact, they're not only expecting it, they're counting on it, because they've already spent the money. You see, the credible threat of just providing the stimulus check will get people to have a wealth effect and go out there and start spending their money. And this is the kind of thing that we can anticipate to take place over the next few years. I see the Federal Reserve bringing down those short-term interest rates. They may even take them negative, right? I mean, if you think about it, the real return on these things is negative right now. If you buy a bond and held it to maturity, the purchasing power, at least in the situation we're sitting in right now, the purchasing power of that bond come maturity, like if you buy a 10-year bond, is going to have less purchasing power than today. It is guaranteed loss. If you do not, I mean, even if you make a tiny fraction of interest off of it, the purchasing power is lost over time. So treasuries are already negative in real terms. And that's what makes gold so attractive, is that even though it has a zero interest rate to it, it doesn't carry a negative interest rate to it. And yes, gold goes up and it goes down in price. But over the long-term average, gold has been a very safe, very well-performing asset. So it's hard to tell. It's really hard to tell if the Federal Reserve can pull it off, if they could steepen the yield curve, if they can create that inflation expectations and they can get the investors to move away from the safe havens like gold and move into the equities and real estate, then we could probably see those markets boom again. But it doesn't really have to do with the actions of the Federal Reserve as much as it has to do with the expectations of the people. They have to believe what the Federal Reserve is saying. This is the reason why everybody says you don't fight the Fed. Okay? Because everything within me, when I hear what the Federal Reserve is doing, when they're printing up all this money, when they're pretty much insisting that the government go deeper into debt, more fiscal stimulus, bigger deficits. When I hear these things, I just think, you know, if it was my personal household that this was going into, like, I come up to a point where it's just like, man, we guys, you know, our household is really in bad shape. Like, we don't have a whole lot of food here. The power's starting to go out. There's all kinds. You know what we really need to make things smooth over again is a big old fat credit card. If we had a credit card right now, everything would be fine. That's what the Federal Reserve is basically telling the government right now. You guys need to start using that big fat credit card. Okay? And will it make it look, you know, when you have that credit card and you're spending it, the appearance from the outside, if people don't know that you're using, I mean, even if they do know you're using the credit card, the perception from the outside looking in is like, man, those people over there really look, they got the nice big house, they got the new clothes, they got the new car, constantly spending money. Those guys are in it. Those guys are doing really well. You know, and that's the situation that I feel the Federal Reserve is trying to put the government in right now, the United States government into. It was just like, hey, we need to make our house look really good right now, so you guys better take out some huge debts and, you know, start running around here, making it happen. Don't worry about the future. I mean, those debts will come due at some point, but, you know, that's off there in the distance. We're not going to worry about that today. We got bigger fish to fry today. We'll deal with those problems later on. That's ultimately what they're saying. Yeah. Anyway, I guess I'll leave it at that. And I'll leave a link down in the description for you guys. Uneducated Economist. You let me know.